Hi, everybody, and welcome back to our first video on Chapter 20, Master Budgets and Planning. Just as a preface to this chapter, I think I was always a little bit irritated, I guess, trying to do budgeting in the for my companies when I was at lower levels, because I really didn't appreciate what budgets do. And I think I want to emphasize in this chapter this planning piece of the budgets. Budgets really are important from the standpoint of trying to, um, optimize our product offerings and how we're going to proceed as a business. It's often an iterative process doing budgets as well because we're trying to find that sweet spot where we are uh, performing at our most optimum level. So in this chapter, we're going to describe some of those benefits that I just alluded to and look at preparing a direct labor budget for a service firm and analyze the revenue per employee. We're going to take a look at operating budgets of the master budget for a manufacturing company. All those budgets work together to prepare a cash budget, and then eventually, we budget pro forma financial statements, budgeted financial statements, and then we'll take a look at some of those components of that master budget as well. So, the benefits of budgeting. Uh, Here, they tell you that we're going to develop this budget, compare our actual to budget, maybe take some actions to fix some of those shortfalls, and maybe reset new plans. And that brings us all the way back to developing a new budget. Now, that's the process of planning for future business actions and expressing them as formal plans. And it's really the first time in the year that you really could sit back and think about what you want to do in your company as you're going along. And that budget then is we formalize it, we publish it, we put it in dollars and cents, but it forces the management to think about how they're going to do what they're going to do. And from that standpoint, the budgets are very valuable. It's a budgetary control process, and we can then use those budgets to see how well we're attaining the objectives that we want to meet. So, what does that all mean? Here's the benefits of budgeting, and they've created a nice little chart for us here. It focuses on future opportunities, and for that matter, threats. Um, it's a motivator. Hard to remember that sometimes as you're doing it, but it does. It makes everybody know what their piece of the action is and what their responsibility is towards attaining that. And that is motivating when everybody is on the same page. Um, Sloppy budgeting, on the other hand, can be a little bit demotivating, but we want to do good budgeting. And that communicates a specific plan to all the employees. And in a perfect world, each employee will know what their responsibilities are towards the future of the company. And it also provides a good basis or benchmark from which to evaluate performance. And so at the end, we coordinate the activities of all our employees and departments so that we're all marching in a straight line towards the company's overall goals. Budgets can be very positive, motivating forces when the goals reflected in the budget are challenging but attainable. We never want a perfection in our budgets. People are not perfect, companies are not perfect, things happen. So we want to have challenging, but not a perfectionistic budget. Employees affected by the budget should help prepare it. Very important to get, it takes a lot longer to do that, but you get employee ownership and you get the benefit of their thought process in that budget preparation. And lastly, the evaluations offer opportunities to explain the differences between actual and budgeted amounts. And that process is very valuable in managing the budget or managing the company. Potential negative outcomes, though, when you have pressure to meet, call it unrealistic goals sometimes, that can pressure employees to engage in unethical behavior or even commit fraud. And that's a real downturn, a downside risk of bad budgeting. Employees might understate, I call that sandbagging, sales budgets and overstate expense budgets to allow a cushion so that they can attain it and look like heroes, right? It's very important to get the sales budget right. And consequently, to me, if the sales budget overachieve or underachieve, it's bad budgeting. You want to hit the budget. And so I make the sales people's bonuses based on how accurately they forecast. And it's amazing how well they can forecast when their bonus depends on that. Employees might spend budgets on unnecessary items to ensure the budget's not reduced in the next period. Zero-based budgeting sometimes can look and say, well, what did you spend last year? Okay, that's what you get for next year. Well, the employees figure that out pretty quickly and just spend a lot of money that they didn't need to at the end of a period or year. Continuous budgeting is applied by preparing rolling budgets, not as frequent in my experience as it should be. But in other words, you're always looking at maybe a 12-week running budget process, 3 months. And that can be very helpful in fixing problems that existed before or adjusting to new situations, et cetera, et cetera. And that way you can continually revise the budget as time passes. That's what we lovingly call a rolling budget. And that's where the company revises the entire set of budgets by adding a new quarterly budget to replace the quarter just elapsed. And a nice practice, but very time consuming. Okay, now we're going to prepare the operating budget for a manufacturing company. And as you can imagine, this process is very involved. First of all, we got to have a good sales budget. Everything flows from that sales budget. And I talked about some of the problems I've had historically and how I fixed them. Then production figures out what they need to do to make what the salespeople say they need to sell. And they create a direct materials budget, a direct labor budget, and a factory overhead budget. And as you know by now, we use that number for our predetermined overhead rates and other forecasting things that we use in the plant. Now we have one more operating budget, and that's the selling expenses and general and administrative expenses. And normally companies do budget separately for those two kinds of expenses. So those are our operating budgets, as color coded here in light yellow. But over here, we have capital expenditures. Sales forecast is going to determine in many ways how much money we're going to spend on capital budgeting. And I'll say 90% of those dollars are spent by production for making those products that sales have forecast. So that's all of these budgets then are going to flow into, finally it gets to me, the chief financial officer, and I need to convert that into a cash budget. And I need that because I need to know as much in advance if I need to borrow money, maybe even sell stock, or whether I'm going to generate enough cash to be able to support the company's operations without borrowing, or maybe even pay back some of my borrowing. So a very important and very tricky little analysis uh, for doing cash budgeting. Then once we've got all of that, we can put it together into budgeted financial statements. And we'll do the income statement, statement of cash flow, balance sheet, and statement of retained earnings, and statement of equity, and all of that that you previously learned about in 1A. So now we'll take a look at the master budget balance sheet, and here she is. We have assets and liabilities and equity, and we have all the things that you would expect to see in a manufacturing company with our inventories and equipment and et cetera, et cetera. Now, first we're going to start out with the sales budget. And the sales budget here is for Toronto Sticks Company, and they sell hockey sticks at $60 a piece. So from the sales budget then, we're going to say, okay, October, November, December, quite a bit of variance in volume by month here. Maybe Christmas people are buying hockey sticks more so than they did in October or November. But my guess is, although it doesn't show here, in the summertime, not much ice skating available unless you do it in a rink. And maybe the sales falls off at that point in time. But nevertheless, we can cost that out fairly easily by multiplying the selling price per unit times the budgeted sales units. And they are as shown for this quarter. All right, now production requirements. Now, a manufacturer is going to prepare a production budget, which shows a number of units to be produced in a period. So the production budget is going to be based on the unit sales projected in the sales budget, along with inventory considerations. And you'll remember how we did that in past chapters. We're going to start with the budgeted ending inventory units, add to that what we need to make, and subtract out a beginning finished goods inventory units. So the required units for the period are going to be the ending inventory amounts. Sometimes we want some safety stock or something like that, and our budgeted selling units. But we already have some in stock, so we don't need to manufacture them twice. They're already there. So a manufacturing budget then does not show costs at this point. It's expressed in units. So if I look at that real quickly, I can see that that's just what I did. That looks like a good place for us to stop for this video. And when we return, we'll take a look at this production budget in a little more depth. Until that time, bye for now.